Hi, everybody. Hope you're doing well. Really appreciate you coming and spending some time with us virtually today. This is our first attempt at a new format where I'm going to be having what we're going to call a fireside chat with Matt, who really oversees our entire institutional advisory practice and our wealth management practice here at Sentinel, helping with fund selection and asset allocation, and his team oversees the billions of dollars that Sentinel has been entrusted to help families and institutions across the country. So I'm really excited to try this out. As you can see, I'm in my kitchen. I'm not in the office. I'm doing this from home. Matt's in his office today, and we're super excited to get this started. We think the format's going to be 20 or 30 minutes long. We had a lot of great questions come in. We have a ton of people on the phone today. So we're going to try to answer as many questions as possible. I'm going to ask Matt some investment and market related questions, and then we're going to flip the script, and Matt is going to ask me some financial planning questions. So in the meantime, I'm going to be looking and monitoring the Q&A box to see if there's any other questions that weren't submitted before this in there that we'll try to address. But again, all the things that we are going to go over today have been submitted by clients of ours. So we're going to try to answer those today. So we're going to look forward to have some fun. So moving forward, Matt, let's start this off with an easy one. I love quotes. So in advanced preparation for this kind of fireside chat, and I see we've been joined by our third panelist today, Dave Batchelder. Dave, can you hear me? Just giving a
quick sorry I'm late.
Perfect.
So, technical issues.
Welcome to 2021. The extension of 2020 continues. So Dave is also a chartered financial analyst like Matt, and helps to oversee the same team that I described Matt's responsibilities for. So we're just going to kick it off with some fun stuff to get it started. So Matt, you've been in the investing business for a long time. What's a favorite investment quote that you have?
Yeah, great question, Ross. Thanks for asking, and hello, everybody. This was a tough one because there's so many great quotes, obviously, and I could rattle off 100, but I think I tried to pick one that kind of resonated with me, especially in light of 2020, and that is there was an economist from back in the 1900s, way back then, John Maynard Keynes, and he is famously quoted as saying, when the facts change, I change my mind. What do you do? And there is some actually question whether he was the originator of that quote, but let's just give it to him anyway. And I think, to me, that quote speaks to not being dogmatic, being flexible in your approach, open to new ideas. And certainly in a year like 2020, where things shifted awful quickly after Q1, it was definitely a good idea to be flexible in your approach. And when things change in terms of the market reaction or fundamentals, you should be open to changing your opinion. So that's the one I went with.
Very cool. Very cool. And if I could ask you, Dave, just to get this started, as a started financial analyst and being in the industry for so long, what's an investing quote you love?
Well, I didn't go back as far as Matt did, but it's a bit unusual for an investing quote, but I think it still applies. FDR said this, during his inauguration speech during the height of the Depression, and we all know this. Only thing you have to fear is fear itself. And this is what I get out of the quote. I look at it like life. Investing is about calculated risk. Nothing for sure in life, just like investing. But opportunities and wealth are generally created when everyone is fearful. So I think groupthink is pretty dangerous when it comes to investing, consensus views. So, we as a team do a lot of deep diving into macro themes on how we want to invest. And I also relate this quote to sometimes talking to my kids about it. I say sometimes it's kind of an analogy to it. Sometimes you have to jump into the deep end to learn to swim on your own. So I'll leave it there.
Very cool. Well, I'll have to use your quote with my 8-week-old and see if he gets into investing just as much as you do. So, I had one cool quote. I love quotes, so I wrote this one down. I think most people know who Warren Buffett is, one of the most successful investors of our time. And he said, someone is sitting in the shade today because someone planted a tree a long time ago. And I think about that quote because it reminds me of, investments are so important, but so is kind of financial planning and taking the right types of investments that you can own as part of your family or your retirement plan and letting them grow for a long, long time. So cool quote. Figured I'd share it with everybody else. So now we're going to get off the quotes. And what I want to do now is ask Matt just to give everybody a rundown of, 2020, what went on. I think we all know there were certainly a number of challenges around the globe, obviously, but from an investment perspective, can you run through, and I'm going to share my screen for you, Matt, just a little bit of what happened in 2020 from a market standpoint and so forth. Can you see my screen in the market category returns, Matt?
Yeah, it looks great. Thanks, Ross. And I'm sure some of you on the call are familiar with this page. We use it in a lot of our client meetings, and it's simply a one-pager that speaks to the market stats. And in the bottom section where I'll start, we look at the major market averages. All the numbers you're looking at are through the end of 2020, and everything is sorted by that first column, the year-to-date column. And I'll keep this high level, just hit on a few things from last year, but again, in this bottom of the page, we're looking at the major market index performance last year. The NASDAQ was far and away the winning index, over 40% return, home to a lot of the large tech companies, which did so well last year, despite the challenges of the pandemic. And then as we go down the line, you'll notice the Russell 2000, which is the small cap index, S&P 500, everyone's familiar with, the largest 500 companies, up over 18%. The next line item you might not be familiar with, but this is the MSCI ACWI index, and this looks at foreign stocks outside of the U.S. And while the return was double digit, you'll notice it notably lagged the U.S. indexes. So that was one of the themes from last year. Foreign markets continue to lag the U.S. Then the Dow Jones up almost 10%. The next line item is the aggregate bond index. Now, bonds had a quietly great year. We know stocks get all of the headlines and all the attention in the press. And fixed income certainly had a rough Q1 like everything else, but came back strongly. So to get a 7.5% return in a core bond index was really, really good last year. So fixed income investors certainly were paid handsomely. And then commodities bring up the rear, which started to get going later in the year, but for a 2020 full year look, still negative for the commodity index. So that speaks to the indexes. I think just broadly speaking, last year, we know Q1 was very problematic as the pandemic really came into focus and really started to have an impact. But things gradually improved from a market perspective in Q2. But then Q3 and Q4, the latter half of the year, markets really surged higher. And for a few reasons, I think probably looking toward hopefully the end of the pandemics. We got a lot of good vaccine news, especially in November. We got past the elections, which I think was a relief for many folks. And so certainly when you start to look out to the new year, there was a lot of optimism. But what I'll leave you with before I go to the top of the page is, overwhelmingly what influenced markets last year was the amazing amount of stimulus that the Federal Reserve pumped into the economy. There was a lot of support for financial markets, a lot of money created, flooding into the system, which found its way into equities. And this is really what was the driving force last year, was just the incredible amount of stimulus going into markets. And so very quickly, before I turn it back to Ross, this top section of the report looks at some of the major mutual fund averages provided by Morningstar. And again, we're ranking these based on how they did last year. And as you'd expect, there's a wide variety depending on your location in the markets and what asset class you're looking at. But again, generally speaking, the foreign stock funds lagged the U.S. So at the top of the page here, we're looking at 3 U.S. categories, which were the leading gainers last year. And as we go down the line, you'll notice at the very bottom are 2 real estate categories, categories that have done well in the past, but certainly with the challenges of the pandemic, real estate was not the place to be in 2020. And we could, pick through certain other categories, but suffice it to say, the broad themes from last year were U.S. beating foreign, growth beating value, and fixed income quietly having a very good year. So I'll stop right there.
Thanks, Matt. As always, that's I think a great rundown of what happened last year. And I've stopped sharing my screen so we can get off of that and just get back to a conversation. So, Dave, with an extension of what Matt was talking about, what was the best place to be invested last year in 2020?
Well, Matt pretty much summed it up very well. But essentially, if you look at that page again, pretty much anything that wasn't nailed down was a good place to invest. From a broader standpoint, just top level, points I want to show or talk about is the market had a bigger breadth of returns and performance than it usually has, over the past few years. So especially in the second half of the year, where small caps and mid caps outperformed, and actually small caps and mid caps outperformed large caps for the year. That hasn't been too regular over the past few years. Growth won the year, growth stocks, but value won the quarter. And, that was probably partially because of a rise in rates, relatively speaking, on the 10-year, helped the banks. But longer term bonds, it did hurt. That's not showing on this graph really, or Matt's chart, but when rates go up, long-term bond prices come down. So just a quick one on that one. Foreign stocks bounce back on the whole because of a weaker dollar. But the winner again, second straight year, was technology sector, and energy stocks actually stole the show in the fourth quarter with the bounce back in oil prices. So
awesome. Thanks, guys. So we've gone over the broad overview of what happened in 2020. A big question, we got this one a lot, was what should investors brace for in 2021? And I know we don't, nobody has the crystal ball of what could happen, but Matt, what should investors planning for retirement, looking at their investments, potentially look out for in 2021?
Yeah, it's a good question. And I think, first I would say, expect the unexpected. Perhaps not to the extent from last year, hopefully, but certainly things do seem to come out of the woodwork. But I think right now the markets are looking at, here's the narrative, right, that the markets are looking at. They're looking at vaccine distribution, hopefully making great progress on that and getting a large percentage of the population vaccinated by midsummer. This should lead to better growth in the economy, especially in the second half of the year. This should gently push interest rates higher, lead to some inflation, and kind of get us back to running where hopefully in 2022 you have more of a full normal year. So that's the current narrative. I guess where I would caution that, I think we've already seen here 3 weeks into the year that the vaccine distribution has had some growing pains, if you will. It's not going quite as fast maybe as people would have hoped a month ago. That doesn't mean it's not going to happen or be successful, but I think the idea that by summertime we're all back flying, attending concerts, going to football games in September may be a little optimistic. And so if that path takes hold, I think you could see the markets certainly pause and reassess the outlook for the year and maybe cause some of this recent momentum, which has been excellent, to slow down and take pace. The other issue, needless to say, is what's going to happen with the new administration in terms of proposals, spending, regulatory issues, and all of that's going to unfold much clearer over this, these next 90 days, I would assume. And right now markets seem to be taking it in stride because I think there's not much information out there that you can really sink your teeth into in terms of concrete actions and what the impacts will be. So I think progress in terms of COVID and the vaccine, along with any new government policies, will be probably the main drivers. What will be constant is that the Fed will continue to be supportive of the market. Stimulus will keep coming in, and we're just going to keep an eye on those things going forward.
Thanks, Matt. So one word I kind of caught on there was momentum, and I think this might translate into the next question we received multiple times. And Dave, I'm going to ask you this one. We were asked by a number of people, what are the FANG stocks? And we keep hearing about these. So wondering if you could explain that a little bit and what your thoughts are on what the FANG stocks are.
Sure. So FANG is F, and then there's a double A there, which people probably don't think about when you spell the word FANG, and then an N and a G. So the stocks that it actually qualifies for is Facebook, Apple, Amazon, Netflix, and Google/Alphabet, if you want the formal name. But really, I mean, never mind FANG anymore. The thing that really to think about is there's still a moniker, but it's been replaced. The FANG and the N in FANG has been replaced with M, Microsoft, where the N in Netflix, if you replace it with Microsoft, which is much higher market cap, you're going to have a bigger picture as to the concentration that's happened in the technology sector and also the S&P 500, the general market index. So if you look at those 5 stocks, that FAAMG, I don't even know how to pronounce it, but the market cap of those combined is over 20% of the S&P 500. So there's a high concentration there, and those companies have such control and such exposure to that index. So again, it's nice to see that this past year, especially in the second quarter, we had some more breadth in the market in terms of small caps and mid caps. Value helped out a little bit, came back a little bit, as we just mentioned. But I remember a Bloomberg chart back in, I think it was July, that measured the FAAMG stocks. The combined market cap of those companies was larger than the Japanese stock market combined. So it just has to put it in perspective for investors that the concentrated, wealth or capitalization of the world market is so heavy on those tech stocks I just mentioned. Big disequilibrium, been going on for a while. Some point, if you're a believer in reversion to the mean, you're going to see some of that breadth start happening, and it might, this might be the beginning of it. We'll see, with more value stocks having some opportunity, and also the smaller and mid-cap stocks.
Thanks, Dave. So transitioning from one area of the market that seems to have done really, really well to another hot button issue or investing topic, I should say. Matt, we got this one a lot. People are hearing a lot about Bitcoin in the news and wondering if you can do, it's a intricate investment, but if you could do a little overview of what it is and explain kind of how it works, because people are asking what Bitcoin is.
Yeah, I'm glad I got that question. Thanks, Ross. So I think just to level set, we are not experts on Bitcoin. It's certainly an area that David and I have done some work on, and it's something that we're probably not going to be able to do justice with in 3 minutes. Perhaps, who knows, later this year, maybe we do a call specific to Bitcoin. But I will do my best to kind of lay it out. So, Bitcoin is a digital asset, and I'll come back to why it's an asset maybe in a moment. But it's been around for 12 years. It started in January of 2009. So it's not a new technology. It's a young technology, but I happen to have a 12-year-old at home. He's young and growing and a little volatile, a little unpredictable perhaps. So, that fits well with Bitcoin. If you're following the price movements in Bitcoin, extremely volatile. And, internally, when we've spoken with our investment group or when Dave and I speak, again, just in terms of context, we speak with Bitcoin in terms of, does it merit a place in a portfolio for 1 or 2% of your assets? In other words, it's small, but if it does really well, it can have some meaning, right? But if it does terribly, it's not going to mortally wound your portfolio. So, again, our thoughts on Bitcoin is from an investment asset. It's not from a trading perspective. It's not from a sell your house and put all your money in Bitcoin perspective, just to, set the table there. So what is Bitcoin? I think the best way, if you're new to the space, to think of Bitcoin is think of it as digital gold. In other words, it's an asset that resides on the internet on something called the blockchain. This is the technology that powers Bitcoin. And the blockchain is a ledger. It's a technology that is run by literally over 10,000 computers around the world. And it's decentralized. That's the beauty of it. There's not a board of directors. There's not a CEO of Bitcoin. There's not a human being laying out all of the rules for Bitcoin. The Bitcoin rules are based on the internet protocol. It's based on math, and it's immutable. In other words, it cannot be changed. It cannot be tampered with. It cannot be hacked. That's the nice thing about it. So again, tough to get your head around that perhaps, but it's something that's, not going away. Again, 12 years old. It's not a fad. It's here to stay. If you took the value of Bitcoin today, the market cap, and obviously we know from the last couple of months it changes rapidly, but as of last night, the market cap of Bitcoin was around $600 billion. So if that was a stock, it would be the 6th or 7th biggest holding in the S&P 500. So again, we're not talking about a tiny niche penny stock here. We're talking about an asset class that has a lot of money behind it. So it's volatile. I'll keep saying that, but again, just to put it in perspective, the asset value of Bitcoin today is bigger than Berkshire Hathaway, to circle back to the Warren Buffett quote. So why is it valuable? It's scarce, and truth be told, it's finite. There are only 21 million Bitcoin that will ever be created. And from looking at the ledger on the internet, you can tell how much supply is ever out in the market, how much comes to market every day. And when you compare it to, say, the US dollar, you cannot print additional Bitcoin. You cannot create additional Bitcoin. You cannot debase it. So some people view it as an inflationary asset to protect you against inflation, similar to gold. Yet Bitcoin, we would argue, potentially has better features than gold. Why do I say that? Well, I could send, if I had it, of course, I could send $1 million in Bitcoin to my friend in California in a matter of minutes. I can't send 3 gold bars to California in a matter of minutes. And you might say, well, you could just send a wire. Well, if anyone out there has sent a wire, you're dealing with the bank, you're dealing with middlemen, and it's not instantaneous. It's a pain, let's be honest. So again, this is the reason people are getting excited about it, interested in it. And I'll just end with this story that has really, I think, piqued a lot of interest this year in regard to Bitcoin, is that the big institutional players are starting to invest in Bitcoin, to use Bitcoin, and to really take a hard look at it. Whereas about 3 years ago, this was almost purely a retail small investor phenomenon. So I'll leave you with 2 examples. There's a small company in downtown Boston. You may or may not have heard of them. They're called Fidelity Investments. And I'm being facetious, of course, but they have spent millions of dollars in building out a custody business to hold their clients' digital assets, primarily Bitcoin. So Fidelity is all in on this. Mass Mutual, an over 100-year-old life insurance company here in Massachusetts, they recently invested $100 million into Bitcoin out of their general account. And that's not to say they know anything more than we do, or that it's going to keep going up, but to have an insurance company, traditional old school insurance company, invest that kind of money, which to them is a small investment, nevertheless, $100 million is noticeable. You can Google those stories, read all about it. It just speaks to the fact that Bitcoin is gaining some acceptance. And as it does, we think the volatility in the long run will calm down. And there is some there, so to speak, and it's well worth taking a look at down the road. So, hopefully that sheds a little light. Obviously, there's a lot of resources, a lot of reading you can do, and we're happy to have a discussion with anybody on an individual basis about it. Again, full disclosure, we're not experts. We don't have any clients invested in Bitcoin at the moment, and we may never, for that matter, but it is a topic we've looked into. So let me just cut it right there in the interest of time.
Thanks, Matt. Yeah, that's probably one of the most loaded questions I could have asked you to try to condense into a couple minutes. So thank you. In the interest of time, Dave, I am going to pivot to a different question than I had planned for you. And I'm going to ask you, in looking back at everything that happened in 2020 and so far happened in 2021, what's one investing lesson you learned or had reaffirmed in 2020 with everything that went on?
Well, this is going to take this for a little turn, I guess. And it may be controversial, but I'm going to talk about it anyway. I think the biggest thing that surprised me, or that reaffirmed, I guess, what's been happening with policy per se, is that the industry, our industry, seems pretty complacent as a whole for what's happened to markets and to our monetary and financial system with all this monetary and fiscal stimulus, and pretty much accepting it as standard operating procedure. I feel that we've kind of entered a modern monetary theory realm, which, if nobody really understands that, it's basically infinite debt, infinite money printing, spending, become the new normal. Fundamentals, this is the real crux of it, is that investors, who are fundamentally trained and fundamentally looking at the market, seem to have taken a back seat to the enormous liquidity that's been put into the system, where it's allowed some of these companies that really shouldn't exist because they can't pay their debts back, called zombie companies, to exist. And it keeps growing, that number of companies that are in that realm, in that space. So, I just think that a lot of the, I'm just worried that the industry is kind of, using a 80s term of jump the shark, and accepting these and not really looking at what the long-term ramifications are of these interventions to our system. These are, big economic theory or theory questions that we'll have to address at some point. But it's just something that, I personally struggle with as an investor. And I know it makes it more difficult to manage portfolios, given that we are, when it comes down to fundamental investors. So.
Thanks, Dave. Just in the interest of time, again, we're trying to keep this not to be too long for our audience. Matt, I know we got a number of financial planning questions that you were going to bounce off me. So I was wondering if you could maybe start with those, and I'll try to answer some of the financial planning questions we got from our audience.
Yeah, sure. Let's pivot to that. And so, the first one, Ross, I guess, in terms of your client base, what did you see the best and worst investors do last year in response to the environment?
Yeah, I mean, I think we've talked about it a lot so far in this discussion. Is that 2020 was a unbelievable year in the markets. We had a dramatic downturn and then a dramatic upturn. One of the things I like to look at, and that I think some of the best investors and most successful people I've ever met who have rock solid financial plans and who are on the right track to become as financially fit as possible and enjoy just a wonderful retirement are those that didn't panic. And it is the hardest thing to do when markets are down 10, 20, 30% in some areas of the market. But those who were the best that I saw last year didn't panic because they had a really good financial plan. Those who start working and have a long retirement are going to experience 14 bear markets, according to the MIT Age Lab study that was done a few years ago. And that means a 20% drop from the high in the market to a new low. And we experienced that last year. And you know, for me, and history shows us this, that the drop wasn't so abnormal. It was the speed at which it went down and the speed at which it came back. But if you don't panic, you stick to your financial plan and don't blow up your investment portfolio because you think long term. Because again, you're trying to grow that tree to become really, really big, so you've got some shade one day and have an awesome retirement. I think it's that people just didn't panic, Matt. I'd say that's the best thing people did last year.
Yeah. Makes sense. Next question. Did you see any significant trends in the way people save for retirement?
Yeah, when the pandemic hit, we saw a dramatic increase in savings rates. So personal checking savings accounts. And you just typically see that through history. Again, I kind of like the histories. That's why I love Matt's FDR quote, or Dave, your quote from FDR. But in April, we saw savings rates jump up to about high 30 percentile of individuals take home pay, just putting in their checking or savings account. Because we couldn't go out, we couldn't really do much, and that makes a lot of sense. But I think a lot of people batten down the hatches when these types of things happen. Unfortunately, obviously there's a lot of people who are still having challenges out there right now and aren't able to do that. And we did see some declines in retirement savings rates if people were furloughed or unfortunately lost their job. And we have seen that inequality gap between wealth only become even more highlighted in this country with what's gone on last year. But I'd say those are some of the things that we've seen in terms of the way people shift retirement accounts. So that's a great question, Matt.
Another question that came in more than a few times was related to taxes. Obviously, we've got a new administration. The thought is taxes are going to be going up at some point. Should people be doing anything different in their planning approach or in their retirement accounts related to future higher taxes?
Yeah, so I guess I'll answer that question because I did see that one come across a lot. We're not tax advisors. We're not CPAs. I'm a financial planner. But when you talk about investment diversification, tax diversification is also one of the most important things for a financial plan. And that means having different sources of money that you can draw from in different times throughout your life. For example, there's 3 primary buckets of money you can take money out of. There's a Roth account, which is after tax. Take the money out, it's tax-free. There's a pre-tax bucket where you put the money in, you get a tax deduction, you take it out, then you're taxed on it. And then there's your taxable source of money that may be checking, savings, or brokerage accounts. But we do talk to a lot of people about trying to have those 3 different buckets created. So when you go throughout your retirement and tax code changes, as we all know, it goes up, it comes down. If you can have different buckets of money to pull from in different time periods where tax rates may be up and down, that's going to be a really nice advantage. So tax diversification is really, really important.
Okay, and then I think this was probably the last planning question that we got more than once. But in terms of folks who are planning for retirement, and I'm assuming maybe more closer to retirement, how should they be investing, in your opinion?
Yeah. Um, I kind of like going back to basics, especially when we've been through so much, volatility and just a crazy year like last year, and going back to basics and making sure you've got your kind of your life and your home just as financially secure as you can. So making sure you've got an emergency fund, 3 to 6 months worth of cash just sitting around if something happens. Trying to save, if you can, 15% of your take-home pay into a retirement account. Great savings rates are really, really important. But from the investment standpoint, I like a lot of the things that Matt and Dave, you guys talked about, using all the different things maybe that you have in your Sentinel retirement plan, or if you don't have a retirement plan with us, using all those funds and building a really diversified portfolio. Don't have all your eggs in one basket. Like, for example, we wouldn't recommend people have 100% of their life savings in Bitcoin. We wouldn't recommend that you have 100% of your savings in one stock or something like that. Try to have all of your investments in different areas of the market that also fit your risk tolerance. If you haven't done a risk tolerance questionnaire to reconfirm your investment personality, now is the time to do it. It might also be a great opportunity to go in and rebalance your account. If you're a wealth management client of the firm, Sentinel does that for you. Matt and Dave and their investment team do all that rebalancing for you. You're an institutional client in one of our 401ks, 403bs, retirement plans, you might need to go in and rebalance it yourself if you're not in one of the portfolios we either manage, or if you're not in a target date or risk-based fund. But go back to basics. And I think it's a great thing to take a look at your financial plan once a year and just make sure that you got all your boxes kind of checked off and you're doing all the right thing. You can always reach out to your financial planners at Sentinel. There's a team of certified financial planners, financial wellness educators here that are here to answer your questions. So we stand ready to answer those questions in our kitchens or in the offices, wherever we are. So we're happy to help people when they have their questions. So thanks for asking those questions, Matt. And I think just in kind of gone over a little bit, but I know we've got a couple questions in here. So I'm going to spend just maybe a couple minutes here, maybe asking you guys some audience questions. And I apologize for leaning in, but I've got dad eyes now, so I have to squint to look at the small font. But one of the questions I see right now is fixed income. So with interest rates being so low, is there, and the question is asking about, the potential returns of fixed income moving forward. Matt, maybe I could ask you not to tell us what the exact rate of return of fixed income is going to be, but maybe some of the challenges facing that area of the market.
Yeah, sure. There's definitely some challenges, and David and I were on a phone call yesterday for over an hour with one of our fixed income managers, and he said more than a couple of times he almost apologized to us because he said I can't get that excited about fixed income right now based on the low level of yields. So to us, fixed income is best served as a diversifier in the portfolio today. It still acts as a ballast or a hedge when we get those bouts of equity volatility. But from a pure return standpoint, I'll just assume you're talking about a core fixed income investment. I think the best guideline, and not to say this is going to happen, but is to look at the Treasury yield curve and see where we're at. And right now you're getting around just over 1% on the 10-year Treasury. Corporate bonds, maybe somewhere in the 2s to 3s. So, expectations are definitely low, and we would rather expect low and be surprised with a 5 or 6% return than vice versa. But so we wouldn't give up on fixed income, but I think what you saw last year with that 7.5% return I mentioned for the bond index, we think it's pretty unlikely that happens again. And overall, we don't spend a lot of time forecasting the direction of interest rates, but I think the fair thing to say is we expect rates to stay in this very low range for the foreseeable future, primarily because the Fed has told us so. They're in no hurry to raise rates. But again, we realize that hurts savers. It hurts people depending on income from safe assets. And that's just the environment we're at right now with fixed income.
Thanks, Matt. There are a number of other great questions in here that we would love to spend the time to answer. But it's almost like I'm getting that red flashing light, like my acceptance speech at the Oscars is going on too long. So I'm going to conclude this first attempt at a fireside kitchen office home chat with Matt and Dave. And I just want to end by saying, if we didn't answer your question, please reach out to your financial planner or representative at Sentinel, and we can answer that question in detail. I also just want to say thank you, everybody, for your trust in the firm. It means the world to us to help you or your business with this, with the investments or any type of financial planning or employee benefits that we do for you folks. So thanks so much. I know Julia wants to share one last thing on this slide, but again, just want to say thanks so much to everybody. Have a great 2021, and hopefully we look to actually see you in the near future. So thank you so much. Have a great day.